If you peg the back end of the Treasury market to gold in an effort to continue to allow the dollar to devalue by letting gold go higher and higher and higher and higher and letting the dollar go lower and lower and lower and lower, then you don't need interest rates much higher at all. You can have virtually zero interest rates on the back end of the bond market, redeemability in gold, but gold's got to go much higher. You're going to end up giving away all your gold. So could it happen? Maybe. Maybe that's part of the plan, but I don't see how you can suppress short-term rates and let long-term rates go higher. That's really where the problem is. It's less the short-term and more the long-term rates that I think they're worried about.
As usual, the precious metals market has experienced another rapid and eventful week, with both gold and silver advancing to fresh nominal record highs against the US dollar. The pace of these moves reflects more than short-term market momentum, pointing instead to growing unease around the broader political and monetary environment. Recent commentary from Andy Schectman underscored how quickly conditions are evolving, noting that attention is shifting beyond price action toward rising scrutiny of central banking itself. Ongoing debates surrounding the Federal Reserve and renewed pressure on its leadership have intensified concerns about whether monetary authorities can still operate independently at a time when confidence in fiat-based systems is already under strain. Schectman argued that much of the political tension appears linked to demands for lower interest rates, despite the long-term consequences of prolonged monetary intervention. He highlighted how years of artificially low rates have distorted capital allocation, inflated asset valuations, and left governments increasingly reliant on cheap financing to manage expanding debt burdens. As refinancing costs rise and bond markets require greater central bank support, he suggested the global financial system is drifting away from a normal cyclical adjustment and toward a deeper structural imbalance. In this context, continued monetary easing risks accelerating currency debasement and weakening international confidence in sovereign debt, particularly U.S. Treasuries. Against this backdrop, Schectman emphasized that developments in physical precious metals markets are becoming more significant than movements in paper pricing. He pointed to sustained delivery activity and tighter conditions for physical metal as signals that investors and institutions are positioning defensively amid growing systemic risk. Rather than viewing gold and silver as speculative vehicles, he described their renewed demand as a response to deteriorating trust in traditional financial instruments. From this perspective, the ongoing rally reflects not a fleeting surge, but a broader reassessment of value driven by rising debt levels, geopolitical uncertainty, and increasing doubt about the long-term stability of the existing monetary framework. Now we present the clips from Andy Schectman's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
He wants lower rates, which really is not what we need. You could argue we need higher rates to get prices back to some form of normal, that being asset prices. You look at the Genius Act that is going to be law January 1st at the latest of next year, which synthetically drives down short-term interest rates. You look at Goldman Sachs. I mean, Trump has been badgering Powell forever to lower interest rates, and you look at what Goldman Sachs said 8 weeks ago or a little bit longer than that, and they said if the market believes that the Fed has lost independence, gold will go parabolic. But then I ask, well, what about Stephen Mirren, who was the architect of the Mar-a-Lago Accord, who was Trump's advisor, who filled the first vacated spot at the Fed? And I think the Fed has lost independence. I think what you are looking at is further incentive for nations around the world to continue to dump treasuries and dollars. Who wants to hold dollars or accept dollars for goods and services when we are moving at breakneck speed into a devaluation of the dollar and to more suppression of interest rates? More quantitative easing, as they say, $40 billion a month that they're going to start doing, the lack of quantitative tightening, never getting your balance sheet in order. If there is no separation between the Treasury and the Federal Reserve, I think confidence exponentially erodes globally and the dollar falls further. So it's not a good look, actually. And it to me is rather obvious what he's trying to do. The moral of the story is they want interest rates lower, which is really not good for the situation we're in. And arguably that's what got us in this problem to begin with, where asset prices have become distorted and you have misallocations of resource and capital that has manifested itself into an environment where, rates if rates don't go lower, well, and easy money doesn't continue, you end up having the whole system crush under its own weight. You pull out all of the money that the Bank of Japan now is forced to retreat from in terms of all the money that they've had spread throughout the global ecosystem because of low interest rates in Japan. Again, when the market suppresses interest rates or when the banks, handful of rich bankers suppress interest rates, instead of letting the market do it, you create distortions. Japan is going to have to deal with it. We're going to have to deal with it. And after decades of yield curve control in Japan, and that now bringing their assets and the money back home to buy Japanese government bonds, creating a domestic bid to replace maybe the waning influence of the Bank of Japan. Well, the same thing is true here. They're going to have to deal with it. We're going to have to deal with it. And I think that's what Trump understands, that higher rates will blow up everything. Stocks, bonds, real estate, the insurance companies that are loaded with treasuries, the banks. We saw what happened when the 10-year went above 5%. What happened? What if it went to 10%? And in an environment where the world is selling treasuries, he wants to do this. But it's interesting because the Genius Act will create synthetic demand for the front end of the curve. That is the end of the curve that supposedly that the Federal Reserve has the ability to control, the very, very short overnight lending market. The synthetic demand for U.S. Treasuries backing the movement of money via the stablecoin passage, the Genius Act will do just this. So unless they're going to embark upon yield curve control, and we see Japan moving away from that right now because of where they got, it's not a good thing. And we should be trying to unwind all this stuff, let alone trying to add to it. So no, I think it's a bad thing. It's a scary thing. And it just speaks to a growing rallying cry from the global south to the global south of why not to hold dollars and why to find alternate settlement routes. And also to any folks who are holding dollars, you're silly to do it. Its value is akin to a melting ice cube, and this will just make it worse. I don't know how you do it because the long end of the curve, you're talking the 10-year Treasury is the primary instrument by which mortgages and credit cards are written off of, and lease rates and all that. They all come off the 10-year. Well, who wants to give, our money, or who wants to give us money for 10 years at rates that are so absurdly low? I mean, if rates were to normalize to a level that was commensurate for money creation and inflation, this is why they suppress the measurements of inflation. That's why they lie about the CPI. And because if it were true, if we really understood that inflation is closer to 10 or 11%, as John Williams would say, instead of the 3 that we're being told or less, no one would buy things like 10-year Treasuries to guarantee a negative real return. So in order for the 10-year Treasury to find demand, either rates have to go much higher or, as Judy Shelton says, peg it to gold. Now, if you peg the back end of the Treasury market to gold in an effort to continue to allow the dollar to devalue by letting gold go higher and higher and higher and higher and letting the dollar go lower and lower and lower and lower, then you don't need interest rates much higher at all. You can have virtually zero interest rates on the back end of the bond market, redeemability in gold, but gold's got to go much higher. You're going to end up giving away all your gold. So could it happen? Maybe. Maybe that's part of the plan, but I don't see how you can suppress short-term rates and let long-term rates go higher. That's really where the problem is. It's less the short-term and more the long-term rates that I think they're worried about.
Recent developments in the metals market suggest that pressure building at the institutional level is beginning to work its way lower, and Andy emphasizes that this transition could unfold in a disorderly manner. He explains that the scale of recent deliveries is extremely unusual and signals that physical metal is being pulled out of the system at a pace rarely seen. Although retail demand has not yet reached speculative extremes, Andy notes that early signs of tightening are already visible and are likely to intensify. Because large institutional bars ultimately move through refineries to become coins and smaller investment products, stress at the top of the supply chain almost inevitably flows into the retail market. He also points to a striking gap between these developments and mainstream financial coverage, which continues to minimize record prices and, in some cases, frames the rally as a cue for the public to sell rather than recognize the deeper structural issues forming underneath. Alongside this, Andy stresses that short-term caution does not contradict long-term conviction. He acknowledges that sharp pullbacks are common in thin markets after strong vertical moves, often driven by profit-taking, leverage, or sudden margin changes. However, he frames these corrections as technical events rather than fundamental shifts. In his view, the real danger is not a temporary dip in prices, but a scenario where physical metal becomes difficult to source at any reasonable premium or delivery timeframe. Andy explains that these pullbacks are not the result of surplus supply, but of paper market mechanics, which is why he views them as opportunities rather than warnings. From his perspective, the underlying conditions, tight physical availability and persistent demand for real metal, remain intact and continue to point toward a far larger repricing as the physical market increasingly asserts control.
Well, we talked about the deliveries that we saw in December, which right before the end of the year, which to me is telling the real story. Delivery behavior is telling the real story. And this is not speculative positioning. This is a fight over real inventory. And to me, December really jumped out. 3,706,000 ounces of gold were delivered and 64,730,000 ounces of silver. 64,730,000 ounces of silver were issued and stopped. That means delivered. And a mint box of Silver Eagles weighs 42 pounds. What does 65 million ounces weigh? And who's doing it? But this is every single month. I've been screaming this every single month since a year ago, November. That's the largest December influx in the history of the COMEX market, which goes back to 1974. And January, which is not a major scheduled delivery month, in just the first few days of the month, we've seen pretty damn well near 35 million ounces of silver delivered. 35 million in a non-delivery month within a week of trading. You add that to what we already saw delivered in December, and you're over 100 million ounces of silver that's been delivered in a little over, a month and 5 weeks. And, that's almost the amount of silver that was mined by just the silver mining companies last year. There was 800 million ounces mined, but the silver miners, according to Rick Rule, only came up or responsible for 17 or 18% of that. So what's that? That's 12, 13 million, 120, 130 million ounces. Well, that was almost completely delivered just in the last month of December and the first 2 weeks, if that, of January. The rest was byproduct mining from the zinc, copper, and lead mines. But my point is that whoever is doing this, they're doing it for a reason. Look, in terms of silver, people need to understand it's a tiny market relative to the capital that can and is flooding into it. And when that happens, the move will be fast, as we're seeing, and disorderly, perhaps as we will really see. And in short, I think it can very quickly cascade on down into the retail market. Now it's starting to get a little bit, it's bubbling in the retail market. It isn't where I think it needs to be. It's not frothy at all. But what you see at the highest level of huge deliveries that are as unusual as a 10-leaf clover, let alone a 4-leaf, yeah, I think it will start to trickle down into the retail market where availability becomes very difficult because we're seeing it at the highest level. And at that highest level, those institutional sized bars, well, those are the ones that find their way into refineries that make coins and smaller investable bars. So yeah, it's coming, but not here yet. But it is coming, and you can see it through deliveries that are so far outside the realm of normal that the fact that guys like Jim Cramer and any of the Main Street analysts who supposedly care about the public, the lack of any journalistic integrity is appalling to me. This, to me, is a much, much more interesting story than the crap that they talk about every day, and yet there's not a word, not even a word that silver's at all-time highs, unless it's Reuters calling it the devil's metal and stuff. So yeah, it's just appalling to me. Some caution is always warranted as far as what you're saying about these talking heads, especially after a move like we've seen. When everyone starts talking about something being a certainty, that's when the market will remind us that it doesn't care about your conviction. That said, yeah, in the short term, sure, it can pull back. It's a thin market. And after a vertical move, you can see what's called an air pocket or a sharp air pocket. That is a function of profit taking, of margin pressure. We saw margins increase, of headline risk. Yeah, you should sell it. It's at its top, you name it. But look, a $10 or $20 correction in silver is not only possible, it's normal in a market that's moving like this. But it's the underlying conditions that got us here. Tight physical availability, massive delivery demand, in a paper market that is now being asked to settle real-world demand, not make-believe on paper, in real metal that they may not actually have. So yeah, I mean, could the metals drop? Of course. And I'd actually be surprised if we don't get some violent pullbacks along the way. But, not trying to sound like a salesman, because I'm not. But in this respect, dips are a gift, because these dips would be driven by positioning limits or positioning and leverage, raising of margins as an example, not by a sudden surplus of metal. So I don't know. I think the bigger issue is it's not, the risk isn't in silver going from 80 to 70 or gold going from 4,600 to 400. The risk is waking up in a market, and you've seen this yourself since you and I have been working together, where you can't get what you want at any reasonable premium or any reasonable price, and the price you thought you'd be able to buy it is gone. And so yeah, short-term caution, absolutely. Long-term conviction, absolutely. In my opinion, both can be true at the same time. You can be cautious short-term, but very much convicted long-term, and that's the proper way to look at it, right? And not be so bullish that you don't see some pitfalls, but be bullish enough to hang on when you get bumped, and because the bull wants to throw you off at every chance, that's for sure.
Looking ahead, the next phase is likely to be defined by a widening gap between quoted prices and real-world availability. As more metal is drawn out of vaults to satisfy delivery demands, inventories that once seemed sufficient may suddenly appear thin. This does not necessarily unfold in a smooth or orderly fashion. Instead, periods of sharp advances may be followed by abrupt pullbacks, not because the underlying shortage has eased, but because market structures strain under the weight of competing claims. Over time, pricing mechanisms may be forced to adjust upward to reflect the difficulty of sourcing physical supply, especially as industrial demand continues to grow alongside investment interest. As this process develops, the focus may gradually shift away from short-term price movements toward access itself. In such an environment, the key risk is not volatility, but delay, waiting for calmer conditions that never fully return. When confidence in paper representations weakens, preference often moves decisively toward tangible assets, and that transition can happen faster than expected. If this shift accelerates, valuations may reset to levels that seem extreme by historical standards, but are simply a response to years of imbalance being corrected all at once. When availability becomes the defining factor, will price even be the main concern anymore? Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.